Okay, before I start, I want to say very clearly why we're doing this. We're doing this to bring any asset, any vault, any fund, any ETF, any stock, any bond on-chain with atomic instant liquidity. That's the message. It's really around bringing assets on-chain with deep atomic liquidity. Okay, let's start. Briefly, Midas, tokenization business. We bring on-chain investment products on-chain, $2 billion in asset issued last year, $40 million in yield paid out last year. We've been operating for 3 years with no incident. Let's look at some data first. The presentation is on liquidity, and that's really the key point. So why does liquidity matter? The data I'm referencing to here is adoption or collateral use cases in money market. Column on the right are traditional money markets, so real finance, and then there are on-chain money markets. Let's look at some assets. US government bonds, agency MBS, I can't actually read it, but somewhere between 6 and 2 trillion adopted in on-chain money off-chain money markets, and around 2 billion in on-chain money markets. Massive category, and really hope that someday crypto and DeFi scales to that extent. You could argue that solvency drives everything. Solvency, stability, such as T-bills, drives the adoption to those markets. But liquidity trumps everything. And you see this along that equities or even Bitcoin, which are volatile assets, not exactly solvent, but with very deep liquidity, are integrated in very deep volumes. So really, liquidity drives everything first and foremost. And this is really why we're talking about this. Very briefly, why do lending markets or money markets matter? They're a very large asset class in crypto. And for an asset issuer, bringing assets on-chain, we talk about distribution, we talk about a lot of things all day, but really to bring assets on-chain, you need to have adoption in lending markets. Now, why is liquidity not solved? We had many people here today talk about market makers. We all love them. They have a hurdle rate of around 30%, 20% if you're really competitive. You might wonder, 30%, that's absolutely crazy. Well, maybe you should go to the Rect Summit next door and talk to some of the security incidents that you see in crypto, and they justify the high cost of capital. It's a very risky industry. When you make 30% or targeting to make 30%, and an asset turns over every 4 months, so a user holds it for just over a quarter, you have an asset turnover 3 times a year, and that would mean a 10% discount. And these are real figures. So basically, I make a market, and I get 90 cents on the dollar when I make the market with a market maker. And that's really it. It's counterparty risk, settlement risk, and so on and so forth. You can slice the dice in many different ways. You can look at short-term assets, different things. It comes out of the same equation. Market makers effectively take settlement risk and counterparty risk, and that really, really prevents scalability of these assets. It's a really hard challenge to solve. How do we solve it? We build an open architecture for liquidity. That's the first thing. First and foremost, we're not really just building our product, we're building an architecture how we think products can come on-chain. So there are 4 liquidity mechanisms in our infrastructure. Number 1, you redeem the standard way. You make a request and you wait until the asset is settled. 1 or 2 business days, you receive the underlying funds. Then there's an internal liquidity buffer. So let's say you tokenize a private credit fund, like we did last year with MF1, and you say 10% of the assets are held in T-bills. That's basically a liquidity sleeve that provides some buffer on-chain that also causes cash drag. This is inside the collateral assets. And these are the components inside the collateral asset. The third mechanism, which we really sort of bringing and going to dive a little bit deeper in the next slide, is MSL. It's Midas Staked Liquidity. And that's a dedicated pool of capital that's external to any collateral, therefore not causing cash drag, but equally settling redemption. And number 4, there's the OTC market. Our tokens are transferable, composable, and we love integrations to RFQ platforms, third-party platforms. In fact, just today we announced an integration to Infinify, where we're acting as a liquidator for a product global that we just have announced. So we're super excited about those things. Let's go on MSL. MSL is a dedicated capital pool. It sits there, it's on-chain, it's credible. You can see it, you can verify it. And against this pool of capital, against any other asset we've issued, you can make a redemption call that's atomic, so instant, and you immediately receive your funds back. That's really an infrastructure we've solved. This is a little bit at the back end, how it works. There's a capital pool, there's a dedicated compartment, there's a credit facility, and how it works in the back end. But really, how does MSL work, and how does it solve this key challenge of liquidity? The key challenge of liquidity is settlement risk, counterparty risk. It uses a mechanism of a risk buffer. So when you redeem 100 units of an M token, this is an illustrative example, you might get back 90 cents of the dollar atomically, instantly. And then the underlying proceeds are settled. Once they're settled and clear the original value, then you receive the remaining 10 cents of the dollar, 11 if you've generated some yield, or 9 if you made some losses. Remember, if you go to Wintermeat directly, they will give you 90 cents of the dollar and keep the profit. In this infrastructure, as an issuer, we effectively wait for clearing of the asset, which is somewhere between 1, 2, 30, whatever the underlying asset is, and then settle this. This is a risk buffer that's determined token by token and allows you to really scale this. So this is really a piece that we have been inspired by the concept of redemption or audit holdback in traditional finance. These are proven mechanisms, and we believe they will really help to scale liquidity. The impact of this is actually quite dramatic and understated. This is a product that we are launching or just announced with M Global. We'll make some detailed announcement on this, but when you have an asset that generates around 10% yield and you give it 20% liquidity, a cash drag would imply a 2 percentage point dilution. Here we're talking about this product generating 30% more returns than otherwise would be at no additional cost. That's a dramatic change. Ultimately, this creates utility for assets. When you scan all asset classes, put them on a map between risk, reward, liquidity, you ultimately see, as you go up the illiquidity curve, you can generate higher returns at possibly no higher risk, but higher liquidity. So this is a mechanism how we can solve this. We have a dedicated capital pool that sits on chain, and the big announcement we took to last night is that this capital pool has grown to $40 million. So we're very excited about this, and we'll be rolling out selectively to a number of assets. And we have interest from many other market makers that want to plug into this infrastructure and even deepen this. I want to reiterate, it's an open infrastructure. We are very happy to work with third-party RFQs, very happy to work with others, and really scale this because it's a really important mission to drive the future of finance. That's it.